Welcome to a special market update, and as part of the update, I just want to go over one of the advantages of using candle charts and actually, technical analysis in general. And that's only not knowing, when to potentially enter and when to exit, but knowing what not to do. As shown in this cartoon we had made up, sometimes it's better to do nothing than to make something into nothing. So with that in mind, I'm going to lead into my current outlook on the S&P. And for those of you who attended the the webcast I did last weekend with our options education, this is kind of a repeat of that, but we got a lot of requests, at least in this next slide, we got a lot of requests for me to go over this again and then give my ongoing forecast. So what I had mentioned in that webcast, and kind of repeating now, is that a couple of weeks ago there's an article about me, the Candlestick Man, saying he's not buying stocks. And this gets to the idea on the prior slide about knowing what not to do. Notice I'm not saying he's shorting stocks. It just says he's not buying stocks. And let me give you the reason for that. And part of the interview I had mentioned the multiple bearish engulfing patterns, sent some bearish messages for the S&P. And here's the S&P chart, and we'll go through this and my outlook in a couple of minutes. But this is when I did the interview talking about not buying stocks. And these are the bearish engulfing patterns I was referring to in the interview. So very important to note, I'm not recommending shorting. I'm just recommending, at least based on this, not to go long, especially at current levels when I did the interview. And interestingly, a couple of days after the interview, another bearish engulfing pattern. You can see what happened since then, and this is actually through Friday, December 18th. And although this is the first time, actually months ago, many months ago, probably in the summer, is the first time since I recommended going long that I actually turned negative on the market. Here, for those who remember, back in 2013, this is a monthly chart. We broke out of a major resistance area, and based on the change of polarity, the old resistance should become support, and look how nicely it worked. So essentially, since mid-2013, I've been bullish. My upside target was close to about 2200, 2250, so I missed it maybe by 100 points, but I was predicting an 800-point rally, and we almost got that. And then the market started to top out. We got those bearish engulfing patterns. So back in mid-2015, in the summer of 2015, is when I started to send out caution. Or for those who follow our updates, our market updates, is when I actually started to turn cautious. So not really outright bearish, but at least recommending not to be going long. And part of the reason for that is, one, we're very close to my target. Two, the market is topping out here on the monthly chart. You can see how it was going from higher highs to the same highs over many months. And three, well, those consecutive bearish engulfing patterns right near the same resistance around 2150. And another reason for my caution is, here's a monthly chart going back to 1986. And notice the rally from 1987, for those of you like me who very well remember the market crash of 87 where it fell 25%. This was the correction there. So from the sell-off in 87, the low there, to the high that we had in the internet bubble was this amount, the blue line. And what I did is I moved this blue line over here. I just made it red. And you could see that we're actually exceeded the entire rally from 1987 to 2000. This to me is a minor reason, but another thing, it is a reason for caution added to the other three aspects I'd mentioned. So I would still be very cautious here, and there's always a price that says I'm wrong, so let me give you that. First of all, let me give you some key support, some short-term support, or intermediate-term support. Notice the hammer over here, another hammer over here, and another hammer over here. So three hammers between the this is the cash S&P, between the 1875 and around the 1825 area. So that is major support. If the market breaks under that, and notice that the lows here were the same as the lows here, the next support would be down here about 1740. But as I started to say, there's always a price that says we're wrong. Now, let me go back here. Let me go back to the breakout. So just as there was a lot of resistance here, once the market broke above the resistance is when I turned bullish, and with the theory the old resistance should become support. So with that in mind, this was back in 2013, the same concept is true. Although I'm cautious about the market, not recommending buying it, especially anywhere near 2150. If the market, especially on a weekly basis, closes above 2150, then this old resistance around 2130, 2125 in that area should become support. That would be a bullish breakout. But until that unfold, and what should happen is, if we do have a bullish breakout, this old resistance must become support. If it doesn't, say the market gets to 2170, the cash S&P gets to 2170, and then on a weekly basis closes under, I'd say, 2120, that would be a bearish signal. So if the market does break above 2150, this old resistance must hold as support to be bullish. But until that scenario unfolds, I would be cautious, and downside risk is now to the lows of the hammer. I get a question a lot, hey, will we break above resistance? Will we break under support? And I don't work that way. I don't think any technical analyst, anybody can predict if a market's going to break above support or resistance. I follow what I call my if-then scenario. If the market does such and such, then we react accordingly. So if the market breaks above 2150, then this old resistance should become support. We could think about buying it. If the market closes under 1825, then my next target is down around 1740. So I hope you found this helpful. And if you have any questions about the options education that we did the webcast on this week, for those of you who may have missed it, or, these are the hammers, by the way. Let me just show you those hammers. If you have any questions on the webcast we did last week, or any questions about a customized education or a really popular software package that lets you find my favorite candlestick signals, like all these hammers and the bearish engulfing patterns and so forth, contact Paul at candlecharts.com. Thanks and have a great day.